Hey folks, David Frost, My Strategic Forecast. You're here for another episode of Common Sense Market Analysis. Today is Thursday, January 7, 2016. So we pretty much had a bloodbath out there today. And, the bullish pattern on the spider that I spoke about yesterday obviously failed. I don't mean to state the obvious, but here it is. This was the bullish pattern, okay, and it failed. We gapped down. And as a result of gapping down at the open, that takes the pattern off the table. And we just basically got crushed today. So let's go back and talk about, what's going on and how we can make some money from what's going on, because it's coming. So basically the 195 today tried to hold. In fact, let's go over to the 10-minute chart and take a look at that. So here's your 195. We hit it in the morning, actually missed it by 3 cents. We were 3 cents above on the open, and then we started rallying a little bit, trying to recover, and we got back above the 196.38, and then obviously that failed again, and you can see here we tried to recover back above the 195 today, tested it a couple of times, but no dice. We tested it here, failed. We tested it one more time at the end of the day, and that failed. And then we sold off into the close, which is typical for a day like today. So where does that bring us? Well, that's actually a poor close. The fact that we didn't hold the 195, which is an important level. Okay, this was a gap fill here, and it was also another mathematical calculation, and that failed, and meaning we closed below it on the daily chart. And what that tells me is there's more downside coming. So I've got another line in the chart, and I'm not suggesting that we get there tomorrow, but it's possible. Tomorrow could be a capitulation day, and there's a couple of reasons why. Let's talk about them. So first, we have the non-farm payrolls in the morning, the phony jobs number, okay? We don't really give a hoot what the number is because it's made up out of whole cloth, but what we do care about is what the market thinks, or how the market really reacts to that number. That's what's important, okay? So that happens at 8:30 in the morning. So if it's a negative reaction, expect the futures to be down hard again. The other thing that's going on is, and it may get started much more earlier than the non-farm payrolls number, which is China. Now here's the deal on China. Apparently they're taking off the circuit breakers from their market. And that's actually a good thing. And what that means is every time their market's been down, they basically shut it off. And that's no way to run a railroad. So, if you're going to have a real market, you have to have real stocks with a real market operating under real conditions. It's called price discovery. If you're not going to operate a market in a real fashion where investors can find real price discovery on what companies are worth based on where people are willing to buy or sell them at, then you don't have a real market. So they don't have a real market. So they're finally taking off the circuit breakers. Now, if you watched any of the financial media today, they were actually saying that this is a bad thing because they're afraid that China's going to collapse. And maybe it does. But in reality, China's going to find where its market is supposed to be. If that takes a couple of days, fine. If that takes a week, fine. Whatever it takes, that's what it's going to take to produce a real market. Now, what the likely scenario is in my book is that we go down tomorrow, especially early on, and it may not finish down tomorrow, or we may just have an all-out bloodbath tomorrow, one way or the other. But tomorrow is an important turning day. It could be up tomorrow in the morning, and that still qualifies as the turn day. So we don't really know exactly which way it's going to play out first thing in the morning. But what I can tell you is tomorrow's a turn day. It's plus or minus a day. I don't think today was the bottom. I think it's going to be tomorrow or maybe the plus one day, but I think it's tomorrow. I think that following this weekend, let's say this. I think tomorrow is a tough day in the market. I think there's a lot of scared bodies out there following tomorrow. Everybody's already turned bearish. It's a bear market, and it is, but that's not the point. they're calling for another 2008 and all this stuff, right? And so when everybody gets so bearish that, everybody just starts to sell into the weakness, which is what you're seeing now. You have another gap down open potentially tomorrow. Everybody sells into the weakness. That's not when you sell. You sell into strength. You buy into weakness. The fact that we have a turn day tomorrow leads me to believe that we're going to see a throw up, and that's when you want to buy. That's when I'm going to be coming out, whether it's tomorrow or Monday, with trade alerts. I know it's tough to buy. I know we bought Chipotle a little bit early. That's just, sometimes the way it works when you're in the risk business. But all in all, this is when you want to buy. If we get a rally, as I suspect we will next week, you're going to see everything catch a rally. And every single stock that's been beaten down over the last 4 or 5 sessions is going to catch a nice rally. And that's when you have to buy. You have to buy into the fear. I know it's a difficult thing to do, but that's what this business is about. So if you don't want to do it, I get it. If you are so inclined, trim your share size down. If you normally buy 1,000 shares of a $40 stock, buy 500 shares, buy 250 shares. Do something like that. My trade alerts, they're going to come out. I'm telling you right now, the trade alerts are going to come out tomorrow and or Monday at the latest. And when they come out, I've got my eye on certain stocks at certain price levels. They're already there, but I can't come out until I really know that we're going to see the turn. Okay, I have to see that first. I have to see either the capitulation on volume, or I have to see some kind of a signal intraday, or at worst case at the close. So when that happens, they're going to come out. And if you're not willing to buy them, I understand completely. If you are willing to buy them, trim down your share size and buy a third or half of what you would normally buy if you're a little bit, uneasy about it. I totally understand that. So that's what I see in the market. That's what I see in the spider. Could we get to the 189.77 tomorrow, this line here? Yeah, we could. That is possible. That's the next support level that I was able to find. There's some support in between, but not as strong as 189.77. And the fact that we closed today below 195 leads me to believe that it's a possibility. So as the IWM goes, let's run through that real quick when the chart populates. Give me a second. Here it comes. You can see here that, the IWM is very, very weak. The spider was down 2.5% today, which is nothing to sneeze at. That's a big number. On 210 million shares. That's a big number, okay? The IWM was down almost 3% on, more than its average volume of 52 million shares against an average of 33 million. So these indexes, or indices, I should say, are melting down. And this is when you want to, I'm not suggesting, by the way, that this is going to be a long-term bottom. This is a tradable bottom. We're not finished going down. Okay, I'm talking about a bounce in the market for a couple of weeks. Okay, I'm not talking about a long-term low here. I don't want anybody to misunderstand me. There's lower prices coming. But I think we'll see a bounce first, and that's the way, that's the way I'm going to play it anyway. Any way you want to look at it, I'm playing it for a bounce. If I'm wrong, I'm wrong, but I don't think so. I think I have a pretty good handle on when these markets should bounce, and I think it's coming. Transports, 3% down today, 221 points. That was just a thrashing. In order to get the picture, you really need to see the weekly chart. And what I told you last night is that the 200-period moving average was a fait accompli. And we pierced through it today like it wasn't even there. And you're going to find some support, okay? Here is a support area that's coming, pretty soon. I mean, this is support right now. We're at support. The next support is down here, okay, at 6,700, 6,720, 6,710, in that neighborhood, okay? And that's another big down day from today. That's another, 300 points from where we are now, 250 points from where we are now. On the worst case scenario, 6250, 6300. I don't think we get there in this move, but do we get there? Yeah, ultimately we will. But this is where we are. I'm giving you rough numbers. I'm not giving you calculated numbers. All right, so on second thought, I put in some calculated numbers. I figured if I'm talking about them, why not? So basically what we have here is 65.60 and 57.25. 57.25 is probably into the future, but if we get a capitulation sell-off, then this line right here is in play. And it would be, pretty good buying opportunity. You don't have to buy the transports, but just to know that if the transports and the spider gets down to its number, then you're going to find support in the markets, and it's going to be when everybody else is running for the hills. Believe me, as you've seen this many, many times, I've been doing this a long time, okay, been able to navigate many, many markets like this. You want to buy them when nobody wants them. That's just the way it works. Okay, it's very difficult to do. I totally understand. But this is where we are. So 65.60 is the number. Now it's a give or take. That's a mathematical calculation, but it's a give or take. So, it's in that neighborhood, but we could see it, and that could be, a worse day tomorrow if it all happens in one day than we saw today. So I would be very, very careful out there. Let's go over to gold. What did gold do? Gold basically, let's go to the daily chart, and we basically hit the number, right? So gold hit a high today of $1,109.90 against $1,110. So in my book, that's a direct hit. We're off by 10 cents on an $1,100 vehicle or instrument. So that's the number, okay? Should we expect a pullback from here? Well, actually, there's more coming, I believe. We may see a pullback from here, but I think if the market's down again tomorrow, you're going to see gold rip through this number, and you're going to see higher numbers. And I have this one in here that I'm just going to highlight a little bit. And this one is 1135. And then there's some stops in the middle. You'll see 1115 pretty quickly tomorrow if it's up at all. And that'll be a short-term stopping point. You'll see 1125 and then 1135. And I can put 1125 in here. It's more important than 1115. But that's what I expect in gold. So, the colors are off, doesn't really matter. But the point is that, gold is on the rise. So it took a while, but it turned out to be the correct call. I told you it was going to make a big move in one direction or the other when it was vacillating down in this area. It was either going to go up or down $30 or $40, and here we are. And it's still going to go higher, I believe. So there's more coming in gold. Silver caught up today, and we talked about that for the last couple of days. And it usually will catch up, and here it was. It was up 2.5% today. We couldn't close above this high here, which is 1442, but this looks pretty good. We came into the 50-period moving average, which act as the stopping point, which I said was the probable case. And another up day, and we'll close above the 50 moving average, and then you'll get up into this pivot high up here at about 1465. So that's what you can look forward to in silver. Not much more to discuss. It's the same story as gold. If one's going to rise, normally the other will follow. They don't have to trade in tandem each and every day, but when they're making significant moves, they're going to move together for the most part, okay? And all silver did today was catch up with gold. All right, you saw a big up day in GDX, up 4.5%, and we talked about this, a couple of times last week. Here, I'm sure I talked about 1465. We got a little above that, getting to $15, and then the next target would be up in this zone here at about 1575 to $16 is the next target in GDX. So while gold and silver are on the rise, you could expect more more upside in the mining stocks as well. And specifically on a day like today, when stocks got hammered for the miners to be up, tells you something. It tells you that, since there's a bid in gold, and they're mainly priced, the miners are mainly priced based on the relationship to their valuation to gold, then, on a day like today, it's telling you there's probably some more upside coming in the miners. Crude oil, down again. What can I tell you other than you really have to see a reversal day? There's just nothing you can do with this other than watch it fall. The last bullish pattern we had failed, and now we're $2.50 below that number where it failed at. It failed right up here. Okay, it's 36 and a half, let's say. So we're over $2 below that now. So there's nothing you can do other than watch it fall and wait for a bottoming signal, a reversal day. You have to see a capitulation day on volume. You have to see a reversal signal. You have to see an intraday reversal. You have to look for those things, and until you see something to trade against, you don't have it. And you can't trade against today's low because you don't know what tomorrow's going to bring, whether it's going to be down again. And if the market's down, the chances are oil's going to be down. If oil rallies, so be it. It'll rally without me. But until I see a reversal signal, there's nothing you can do with it. It's where the probabilities are not in your favor. So when the probabilities are not in your favor, there's just nothing you can do except wait for those conditions to be in your favor. Wait for those conditions to appear. That's the only thing you can do. So let's move on to the bond market and see what happened here. So the bond market, we got above our 150, what was that number? 155.25, 155.25, and we're at 156.01, and that was on a closing basis. So that's why I said, whether it was yesterday or the day before, I can't remember. It was yesterday. Am I taking this on the short side? No, I'm not. I just wasn't convinced that it was a high enough probability trade. We tried to get back in the channel today and failed. But if we have another big down day in the market, you can expect that the bond market should be up again and yields will continue to fall. And as yields continue to fall, it's telling you that when the market goes down, the bond market is telling you that the Federal Reserve has no business raising interest rates because the market is weaker than they think it is. And when that's the case, when those conditions are prevalent, then they cannot raise interest rates any longer. And they were late to the party with the first raise last month in 7 years. And now that they've done it, you see the market now comes under pressure and the bond market is rallying, yields are going lower. And let's just flip over and I'll show you a yield chart. It's opposite the bond chart, obviously, but here's a yield, the 30-year yield, and you can see it's coming down. And when yields come down, 30-year yield under 3% is telling you that the Fed has no business raising interest rates. Here's the 10-year yield, okay? No business raising interest rates. Underneath all the moving averages, that's a bearish sign for yields. It's in a downtrend below all the moving averages on a daily chart. The same principles apply to every chart, no matter we're talking about bonds, yields, stocks, gold, oil. Doesn't make any difference. All charts are conditions and patterns apply the same. So this is in a downtrend any way you want to look at it. So back to the bond chart. I'm expecting, if there's continued pressure in the stock market, I'm expecting higher prices in the bond market. If we do get back into the channel, then it's going to want to run back up potentially to the top end of that channel. Then we may have a trade on our hands, something to talk about if we get that far. That would be a high probability setup for a short play in bonds, okay? But right now, the odds are not in your favor. Let's go over to the dollar. The dollar came under pressure today, and you can see here it was a pretty good and decent-sized down day. And different than yesterday. Yesterday was just a little pullback. Today was a real down day. Came in and pierced through and closed below the 20-period moving average. And that's a bearish sign, and we'll probably reach into the 382 again And then, potentially we could get ultimately to the target that I've been talking about for quite some time. And this would be an area where you can pick up the dollar if you don't already own it. I will be buying more if and when it gets there. If it does, certainly will, because on the longer time frame, on the monthly chart, on the longer time horizon, the dollar is in a very, very, very uber bullish condition. And nothing has changed in terms of that. Only thing it's doing is on the daily chart, okay, we had a down move and we formed a wedge pattern, and we're potentially starting the completion of this pattern down to here. And if we did go that far down back to the 618, this move here from here to here would equal about the same as this to this. And that is market symmetry at its finest. And that's not the reason, but one of the reasons why I still have a 618 target in my on my sights, or in my sights, because not only for that reason, there's other reasons, but that in and of itself is important to me. I like when market symmetry plays out, and when markets look like they're symmetrical or playing out in a symmetrical format, and we're coming out of a bearish wedge pattern, we start a down move, it just looks to me like it wants to complete that entire move. And that's just from a visual perspective very, very appealing to me. Okay, so did I miss anything? We talked about the spider, the IWM, the transports, gold and silver. We did crude oil, the bond market, the dollar. If you want to look at stocks, Apple got hammered. This trend change day yesterday, the doji candle didn't play out, obviously, got hammered, going to double bottom. If the market throws up tomorrow, you're looking at 92. That'll be good support, but it's got to stay above and close above 92. It doesn't have to stay above intraday, but it's got to close above 92, or else it's in trouble. Or else then you see 82. Or let me just get that number. I don't want to just throw it out there. I'm doing it from memory. Bear with me. Yeah, 82 would be the number. So it's got to stay above and close above 82. But look what you have. You have the 200 period moving average coming up. You have a double bottom. This is a big, big level. This is a weekly level. So tomorrow's Friday. So you've got to close above this level, not only tomorrow for the daily chart, but tomorrow for the weekly chart. So if you're looking to pick up a stock and you believe what I said earlier about the potential for a turn day, and you're in the camp of wanting to own Apple at least for a rally, okay, a short-term rally, couple of weeks maybe, all right? This is the spot. If you can get it at 92 into the 200 period moving average, weekly chart support, weekly chart bottom here, daily chart bottom tomorrow, that's your spot. I mean, if you're ever going to buy Apple, this is one of those times where you would consider doing it if you can get it close to 92 tomorrow. Okay? Another stock, or another ETF, XLE, which is the energy sector, cracked through the double bottom. This was the weekly chart, started yesterday, followed through today, and this is ugly. There's probably lower prices coming, if not, tomorrow, but certainly in the near term, minus a bounce in the markets, after that. But tomorrow, for sure, if the market comes down, so does everything else. There's a couple of other stocks that I'm eyeing, so I'm not going to bring them up here because they're probably going to be found in trade alerts. May still put out Apple as a trade alert, but any way you look at it, there's other stuff that I just want to reserve for the alerts because I've been honing in on certain price levels, and I want to save those for tomorrow and or Monday if we get what I'm looking for. So with that, we're going to wrap it here tonight. I'm David Frost, My Strategic Forecast. Thanks for tuning in for another episode of Common Sense Market Analysis.